An IMF senior official says China's shadow banking system is finally under control. As a result, lowering the reserve requirement ratio will help develop the real economy.
This illustrates that after 2 years of management, the size of China's shadow banking is now under control. This is a good sign for risk control. In this context, by lowering the reserve requirement ratio, traditional bank loans can be promoted, thus providing more support for the creative industries, the service sector, and other emerging areas, all of which is beneficial for the country's current economic restructuring.
Zhu made the remarks at the IMF and World Bank spring meetings in Washington. According to China's central bank, the country's new yuan loans in the first 3 months increased by just under 601 billion yuan from that of the same period last year. Yet China's social financing aggregate, a broad measure of liquidity in the economy, slipped down 895 billion yuan from the same period last year. China's central bank on Monday cut the reserve requirement ratio for all financial institutions by 1 percentage point. Analysts say the cut was within market expectations following lackluster economic growth in the first quarter of the year. China's GDP increased at a rate of 7% in Q1. Zhu said the growth is still within a reasonable range, but is facing downward pressure.
Enterprises are seeing their profit margins shrinking. Overcapacity still exists and competitiveness is still not strong enough. China's industrial chain needs to constantly peel off low added value while trying to build more high added value. Improving profit margins is critical for China.